Hello, it's Joe Follico again, Principal Futures Broker at Insignia Futures and Options. Over the next 4 videos, I'll be detailing futures option spread strategies I found to be the most effective, so stay with me. I'm often asked what option spread strategies are the most popular. There are many variations of spread strategies out there, but in my opinion, there are only a few you need to be aware of. In this video, we'll start with one of the basics, the debit option spread. As the name implies, this type of spread has an upfront out-of-pocket cost or a debit when initiated. The 2 biggest benefits of using a debit option spread are, number 1, it offers a fixed amount of risk, and number 2, it enables you to trade option strike prices closer to the money. Compared to buying an option outright, your risk is fixed to the amount you paid for the option spread plus associated commissions and trade fees. However, by using the debit option spread, you will be able to trade strike prices that are much closer to the money or where the underlying futures prices are trading at, with similar costs to the outright option purchase. For example, let's say you're bearish the December 2022 euro currency and you're willing to risk approximately $700 on an option trade. With the December 2022 euro currency trading at 103.50, you could purchase a 98 put for 56 points or $700. Each point in the euro currency futures contract equals $12.50. As you can see, this option is 550 points out of the money. Conversely, we could also use an option debit spread to go short the market. The debit option spread in this case would consist of the following options. We would buy the 103 even put at 184 points or $2,300 in premium paid. Then we would sell the 101.50 put at 128 points or $1,600 in collected premium. The strike price we purchased at 103 even is very close to where the futures price is trading, as opposed to the 98 put if we were going to just buy a straight out option. In this option spread, our max risk is $700 and our max gross profit is $1,175. Risk is calculated by subtracting the premium received for the option sold from the premium paid for the option purchased. The max profit of a debit option spread is the difference in strike prices less the debit paid for the spread. In order to reach the maximum profit at a debit option spread, the underlying futures price must be at or below the strike price of an option sold at expiration. To calculate the max gross profit, we subtract the 103 strike price from the 101.50 strike price, which equals 150 points or $1,875. Then we subtract the cost of the spread, $700 in this example, for a max profit of $1,175. I hope you're finding this video informative. Please take a moment to like and subscribe to our futures trading channel if you'd like to see more videos like these. One of the disadvantages to the debit option spread compared to a straight out option purchase is that it has a fixed maximum profit. Although a straight out option purchase ultimately has a greater profit potential, I think being able to trade strike prices that are much closer to the money more than makes up for this advantage. In comparing both option strategies, here are a few outcome scenarios for both trades. Scenario number 1. Euro currency futures are trading at 1.0028 at expiration. With the debit option spread, we would realize our total $1,175 profit as both options expired in the money. However, with the outright purchase of the 98 put, the option will have expired out of the money or worthless for a $700 loss. Scenario number 2. Euro currency futures are trading at 0.9778 at expiration. Again, with the debit option spread, we would realize our total $1,175 profit as both options expired in the money. Although the outright purchase of the 98 put expired in the money, we would still have a loss of 34 points or $425 as we have to take into account the 56 points paid for the premium for this put option. Scenario number 3. Euro currency futures are trading at 0.9705 at expiration. Again, we realize our total $1,175 profit with both options in the debit spread expiring in the money. With the outright purchase of the 98 put, we would have a 95-point gross profit or $1,187.50. However, we must deduct the $700 we paid for that option, leaving us with a profit of $487.50. For the straight-out purchase of the 98 put option to achieve the same $1,175 profit as the debit spread, Euro currency futures price would have to drop all the way down to 0.9650, a 500-point difference. Of course, we would sustain a total loss in the debit spread or the outright put option purchase if the underlying futures price was above our strike prices at expiration in either scenario. Keep in mind, futures option trades are not an all or nothing trade. You could liquidate the trade at any point prior to expiration to limit losses or take a smaller profit. Although I feel the futures debit option spread is a very good alternative to a straight out futures option purchase, keep in mind that it still carries the same risks of loss. I hope you found this video informative. If you have any questions about using this strategy, please leave them in the comments below or feel free to contact me directly. I'll be happy to help.